Some financial scandals begin with greed. Others begin with something even more dangerous, the feeling of safety. Allen Stanford did not sell investors a wild fantasy about overnight riches. He sold something that sounded calm, familiar, and reassuring: certificates of deposit, or CDs. To most people, that phrase sounds harmless. It sounds like banks, savings, stability, and money quietly earning interest in the background. But Stanford was not selling CDs through an ordinary neighborhood bank. He was selling them through a world wrapped in the glamour of the Caribbean. Stanford International Bank in Antigua, surrounded by the imagery of tropical wealth, offshore prestige, private jets, elite parties, and the seductive message that your money could be placed somewhere safer, smarter, and more exclusive than the ordinary financial system. That is the kind of invitation many people find difficult to resist. It does not make them feel reckless. It makes them feel sophisticated. It makes them feel as though they have been given access to a private room that most of the world never gets to see. Allen Stanford understood something that the most effective fraudsters always understand. Wealthy people do not only want profits. They want to believe they have access to something rare. They want to believe they are operating above the ordinary crowd. They want to feel that they are part of a small circle of people who know how money is really protected and multiplied. So Stanford never needed to scream that his products were life-changing. He only needed to create an atmosphere elegant enough, exclusive enough, and credible enough that other people would voluntarily walk inside the trap. And that is exactly what happened. In 2009, the curtain was pulled back. U.S. regulators accused Stanford and his related companies of deceiving investors for years by marketing the bank's CDs as safe, liquid, and conservatively managed, while the underlying reality was allegedly very different. The U.S. Securities and Exchange Commission said investors were misled about how their money was invested and how secure those assets truly were. The U.S. Department of Justice later described Stanford as the architect of a multi-billion-dollar investment fraud scheme. Eventually, he was sentenced to 110 years in prison. That sentence was more than punishment. It was the sound of an empire being permanently sealed shut. But what makes this story unforgettable is not only the number of years, it is the scale of belief that came before the collapse. This was not a case of one desperate investor falling for an obvious lie. This involved wealthy individuals, institutions, advisors, and people who had every reason to think they were operating inside a sophisticated financial environment. That is what makes Allen Stanford so haunting as a scandal figure. He did not look like a fraud. He looked like the kind of man people trust with their future. He looked like a successful international banker. And in the world of finance, appearance matters more than people want to admit. At the center of this story is a question that refuses to go away. How can a product wrapped in the language of banking, stability, and offshore prestige absorb billions of dollars for years without collapsing sooner? The answer does not lie in one clever trick. It lies in the mixture of luxury branding, investor psychology, weak transparency, and the constant recycling of trust. Because the real engine of this scandal was not only money, it was belief. The most dangerous financial frauds are rarely built around products that sound reckless. If Allen Stanford had offered investors some bizarre secret strategy no one understood, suspicion would have come much sooner. But he did something far more effective. He took a product that sounded painfully ordinary, the certificate of deposit, and gave it a polished offshore makeover. For most people, CDs do not smell like danger. They do not sound speculative. They do not evoke penny stocks, gambling, or market madness. They sound conservative. They sound like the kind of product careful people buy when they want predictable returns and minimal anxiety. That was the genius of the pitch. Stanford used a familiar financial label and placed it inside a far more seductive package: better yields than traditional bank deposits, an international private banking image, and the suggestion that this was the smart version of safety, not the boring kind. Investors were not told to feel greedy. They were encouraged to feel fortunate. That difference matters. A reckless scheme asks people to suspend disbelief. A successful fraud asks people to believe they are being more intelligent than everyone else. Stanford's operation built that belief through image, language, and social reinforcement. Investors were told, directly or indirectly, that this was not an ordinary product for ordinary people. It was a refined opportunity. It belonged to the world of private banking, international sophistication, and high-level financial management. Many people did not think they were entering a risky structure. They thought they were entering a more advanced version of security. And this is where the social machinery becomes important. People did not only trust the product, they trusted the people around the product. They trusted advisors. They trusted the social circles that repeated the same reassuring story. They trusted the fact that other wealthy, connected investors had already placed money inside. That is how a fraud scales, not only through documents, but through borrowed credibility. Once enough people with status appear to believe in something, the next layer of investors feels less need to verify it independently. Trust begins to move through the network on its own. It becomes contagious. That is exactly what makes scandals like this so unnerving. The fraud is never just one liar telling one lie. It becomes an ecosystem where every participant unintentionally helps validate the system for the next participant. Regulators later alleged that Stanford's bank misrepresented how investor money was invested, including claims that the portfolio was safe, diversified, and liquid. But before those accusations became public, the product lived inside an atmosphere that made difficult questions feel awkward. And that is one of the great vulnerabilities of wealthy investing culture. Sometimes the biggest fear is not losing money. Sometimes the biggest fear is admitting you do not understand the exclusive opportunity everyone else seems to understand. So people stay quiet. They rely on appearance. They take comfort in the fact that the room is filled with sophisticated faces, and Allen Stanford knew exactly how to build that room. By the time many investors started asking what really stood behind the glossy promises, billions had already moved. Then the question became impossible to avoid. If these CDs were marketed as safe, liquid, and professionally managed, where was the money really going? Every major fraud reaches a moment when people stop staring at the polished surface and start asking what is happening underneath. In Allen Stanford's case, the heart of the scandal lies in the distance between two worlds. One world was the story sold to investors, that their money sat inside a well-managed institution, backed by liquid investments, diversification, and professional oversight. The other world was the reality that regulators and prosecutors said they uncovered, a system built on misrepresentations, hidden risks, and money that was not being handled the way investors had been led to believe. When people buy a CD from a bank, they are not imagining speculation. They are imagining custody. They believe their money is sitting inside a controlled structure designed to preserve value. That is why the product name itself was so powerful. It imported trust from the ordinary banking world into a far more opaque offshore setting. According to regulators, that trust was misplaced. What makes this scandal difficult for viewers to shake off is that the fraud did not require absurd promises. It only required a stable enough illusion that investors would stop pressing for deeper proof. As long as account statements looked orderly, as long as returns kept arriving in believable patterns, and as long as the social environment kept signaling normality, many people had little incentive to tear the structure open. That is one of the darkest truths about financial fraud. It often survives not because the lie is perfect, but because the lie is comfortable. People want to believe in things that reward them gently. They want to believe that expertise can smooth out uncertainty. They want to believe that elite institutions can reduce risk while preserving gains. Stanford's operation allegedly offered exactly that emotional package. And once a system like that grows large enough, it becomes harder to challenge. Each satisfied investor becomes an informal salesperson. Each successful redemption becomes social proof. Each advisor who stays quiet becomes part of the wall protecting the illusion. The offshore structure only deepened the fog. Distance can be mistaken for sophistication. Antigua sounded international, private, and high-level. For many investors, it did not sound like danger. It sounded like privilege. That is what allowed the structure to expand without triggering the suspicion that would normally follow something too good to be true. As the case moved forward, the U.S. government described Stanford's scheme as a long-running fraud worth roughly $7 billion, one that allegedly diverted investor funds while sustaining the appearance of a secure banking product. At that point, the story changed completely. This was no longer about a misunderstood financial product or aggressive salesmanship. It became a story about trust being turned into private wealth, and that is why so many people remained haunted by it. Because the central question is painfully human. How could so many successful, experienced people stay inside a machine like this for so long without fully seeing what they were inside? The answer is difficult because it is not flattering. When the paperwork keeps arriving, when the withdrawals still work, and when everyone around you stays calm, doubt becomes a lonely act. Eventually, the machine lost that calm. And when it broke hard. When a financial fraud is exposed, the public usually passes through 3 emotional stages. First comes disbelief, then anger, then the long wait to see whether the legal system will actually punish the person at the center of it. In Allen Stanford's case, the answer came with brutal clarity. After the SEC moved in during 2009, the story no longer belonged only to business headlines. It became a major criminal case. The name Stanford Financial Group stopped meaning offshore prestige and started meaning investigation, fraud allegations, and one of the most notorious collapses in American investment history. Once a figure like Stanford enters a courtroom, the illusion begins to evaporate quickly. The brochures, the private bank aura, the polished events, the carefully controlled image, none of that matters in front of evidence, sworn testimony, financial records, and the cold logic of prosecution. And unlike some scandal figures who end their careers with vague settlements or quiet disappearances, Allen Stanford reached one of the clearest legal endings possible. He was convicted. And in 2012, he was sentenced to 110 years in prison. The U.S. government described him as the man behind a multi-billion-dollar investment fraud scheme that spanned years and caused enormous damage to investors. That number, 110 years, no longer functions like a normal measure of time. It functions like a statement. It says the court was not merely punishing a bad executive. It was burying the myth that this could ever be treated as a misunderstanding or a business failure. This is where the narration should slow down, because the emotional power of the scandal is strongest here. In the minds of many investors, Stanford had once represented security, sophistication, and financial intelligence. In the final legal record, he stood as the leader of one of the largest investment frauds in U.S. history. And that reversal is what makes the story unforgettable. But even here, the scandal was bigger than one man. Public anger did not stop with Stanford himself. It extended outward to brokers, intermediaries, advisors, and the broader system that allowed so much trust to gather around a structure that, prosecutors said, was built on deception. That is why the fall of Allen Stanford feels larger than a single sentencing story. Because every major fraud exposes not only the person who led it, but the many points where skepticism could have intervened and didn't. The legal outcome was clear. The moral damage was not. When the sentence was pronounced, one chapter ended. But another question remained, heavy and unresolved. What happens after the fraudster falls? What happens to the victims, the money, and the trust that was broken? A financial scandal does not end when the man at the top goes to prison. It simply enters a quieter phase, slower, longer, and in many ways more painful. The phase lived by the people left behind. After the sentence, what remained was not glamour. It was loss. Victims had to sit down and calculate what had disappeared: retirement plans, family wealth, charitable funds, years of financial planning, and in many cases, the simple belief that caution was enough to protect them. That is what makes Allen Stanford's case more than just a courtroom story. It is a lesson in how trust itself can be packaged, sold, and stolen. In financial markets, people often imagine risk as something tied to volatility, recession, or bad timing. But scandals like this force a more uncomfortable truth into the open. Sometimes the biggest risk is not the market. It is the human being standing between you and your money. That is what makes the Stanford case emotionally brutal. Many victims did not think they were speculating. They believed they were doing the responsible thing. They believed they were placing money into something closer to safety than to risk. And when that belief collapses, the damage is not only financial, it is psychological. That is why stories like this stay alive for years. Not just because the dollar amount was enormous, but because they force ordinary people to rethink one of the most basic assumptions in finance. What does safe actually mean? A beautiful office is not proof. A luxury brand image is not proof. Wealthy clients are not proof. Even a long list of satisfied investors is not proof. In finance, the only thing that truly matters is verifiable transparency. That is the hard lesson this scandal leaves behind. Allen Stanford built a world out of the language of steadiness, sophistication, and financial intelligence. But when the layers were stripped away, what remained was the image described by U.S. authorities. A man who orchestrated a years-long investment fraud involving billions of dollars and left behind damage that could not be measured only in account balances. That is why this story never fully dies. Every time a product promises returns that look just a little too smooth, every time an investment is wrapped in exclusivity and elite branding, every time a wealthy network treats questions as bad manners, the Stanford story returns as a warning. Not everything that looks safe is safe. Not everything that looks elite is transparent. And in finance, sometimes the most expensive thing you can lose is not money. It is the moment you realize you trusted the wrong person.